Hey, what's going on, everybody? My name's Jose from deepdatainvesting.com, and today's a special one because we got the other face of the duo, Carlos. How's it going, Carlos?
Hey, Jose, pretty good. And yourself?
Pretty good, man.
Nice to join you. I'm usually the one that writes the newsletter issues that go out, and I'm actually really excited to finally join you on one of the videos.
Yeah, man. How's quarantine going?
Not bad. It's we're in Texas and we're a little bit more relaxed on the whole closures and lockdowns. So I've been working from home, but other than that, we I've been going out to the parks and stuff, and it hasn't been that bad.
Yeah, exactly, man. Well, this also has given us the opportunity to build deepdatainvesting.com as well. So I'm really excited for that. So let's get started. So in today's topic, we're going to be talking about investing styles. And so if you haven't seen our previous video, we talked about how to open up a brokerage account or the different options of brokerage accounts that you can open up to start investing. And so to continue on with this beginners investing series, we're going to continue on, talk about the investing styles, some of the investing styles that you have in hand to start off with. So we're going to break this down into sort of longer term investing and then shorter term. So we're going to start off with longer term. So take it away, Carlos.
One of the most, I guess, traditional or well-known ways to invest is by doing fundamental investing, and this is kind of the reason why it's popular is because it's the approach used by the best known or the most famous investor of all time, Mr. Warren Buffett. But who did he actually learn it from? Is the person who actually came up with the concept, which is Benjamin Graham, which was actually Warren's mentor, and he introduced the concept in his couple of books, The Intelligent Investor and Security Analysis, which were published back in 1940s.
If you don't got a copy, it's worthwhile to get one yourself right now.
Yeah,
So.
for sure, definitely get one. And it's by no means an easy read, but but it's all the worthwhile reading it. Now, essentially, the concept of fundamental investing can be boiled down to calculating the present value of a company or security you are analyzing or considering investing in. I can share if I can share my screen.
Yeah, go ahead.
Okay, so I put together a little slide here with the formula. So net present value. And here, I mean, at first it can look a little scary because we have some Greek symbols here and some arithmetic. But once you actually break it down, not that bad. So basically, we're looking at calculating the net present value, which is actually the free cash flows or all discount cash flows minus the price you're going to pay today. So that's actually what sub zero means. It's the price you're paying today per share for the business. Then C sub T is actually the cash flow you expect to get at time T, which is actually or usually measured in years. And then we have also the other variable R, that's actually the internal rate of return. And this is actually what we want to know. This is how we're going to know if this business is actually worth investing in and how much worth it compared to other businesses. And the other part is NPV, or the net present value. You can actually also figure this out by combining the number of shares that are outstanding today and the price per share today. So in a way, we already know this, but we're trying to determine R. So that's kind of in a nutshell what we're trying to do.
So in this formula, what it is we're trying to determine the actual value of the company as it's worth today, right?
That's correct. As it's worth today, and whether the rate of return that we can expect in moving forward in the future is actually worth for us, to get in on an investment. Okay, so one of the things that I wanted to do is actually put this into practice with a company, with an actual company, and I chose Warren Buffett's own company, actually, Berkshire Hathaway. Now, Berkshire Hathaway has two different series of shares. The A and B. So I chose the A shares. So once I go to Morningstar, I type morningstar.com, and then once I get there, I put Berkshire Hathaway here in the search for quotes input. I come up with this screen, and as you can see, we're already given a few interesting information here. So first of all, we know we can see what the current price today is for this company, $271,600. Okay. The other thing that we want to know is the free cash flows, right? The free cash flows and how many shares outstanding there are, so that we can come up with our calculation. So for that we go to ratios, and then we go to full ratio data, and then so here in this nice sheet, you can see the number of shares outstanding. It's 2, but don't confuse yourself. This is actually 2, and it's being presented in millions, so it's 2 million shares. And
always look at the units.
Yeah, for sure. That's be careful with that. And you can see that this is actually an interesting business, because earnings per share and net income, they're nice and increasing. You see, so that's how you can see. They're both nice and having a nice increase as the years move on. And not only that, but also the free cash flow, it's also positive and increasing. So that tells me this is a healthy company, and it's generating some nice income that's going to the shareholders. So what I do then is I grab this information, the shares outstanding and the free cash flow. I use the 10 previous years worth of free cash flow. Make sure not to count the TTM, and I input this. So I use this information to kind of build a model, which will probably it's worth it's a topic that is worth a post on its own. Mm-hmm. For now, we're going to assume that we have a model that when we present the historical 10 years worth of cash flows, it gives us a projection of the future 10 years of cash flows, based on statistical analysis and probabilistic analysis. So when I'm coming up with I put together a nice little spreadsheet here. I'm coming up with the projected cash flows for the next 10 years, which I'm showing, and I'm coming up with the price today for the business. So this is again number of shares outstanding and the price of the share, price of stock per share. Once I input all of these data into my calculation, I come up with a rate of return of 5.1%. Now, once I come up with this, so this is interesting. I mean, it's definitely not bad, but the way you can determine whether you want to enter this position in this company is by kind of doing the same thing, the same calculation, but for other types of securities. Like, for example, the S&P 500. Let's say that you come up with 4.5% return, and the Treasury bond, let's say that you come up with 1.8%. So clearly, by comparing these three, you can see that buying a share of Berkshire is actually it's actually more advantageous for your portfolio than buying into the S&P 500 with the same with today, with the price that we have today for these securities. And that's kind of how I summarize fundamental investing, Jose. So the one thing that I wanted to point out is that the reason why this approach works is because it's based on the fundamental notion that a stock is nothing more than a fraction of a business, and the worthiness of the business can be determined by its ability to generate an income for the people who own it. So that would be the share. So by focusing on the business fundamentals or free cash flows, we are able to get a clear picture of whether the business is healthy and worthy of our investment dollars. So as far as some of the benefits that I'm able to see, and benefits and drawbacks that I'm able to see with this is, I guess you can say it's better when it's applied on a long term and buy and hold strategy, because you know that the business is it's actually worth it, going to generate those cash flows that you projected. So you want to let your money actually materialize those returns over time. So it might take years, or it might take tens of years. So just let your money. It's better if you just let money do its work over time, and forget about the fluctuations, the week to week fluctuations or month to month, because you know that in the end you care more about the long term return of your money.
The actual you for fundamental analysis, you're looking at the actual value of the company versus what the price is worth today in the stock market, which we all know the stock market is just a bunch of noise, handling different events that are happening at the same time. And of course it doesn't necessarily reflect what's going on in the economy. And so what you're doing with fundamental analysis is actually looking at how much a company is worth, what they are worth, what its value is. And you're taking your investment from that.
Right. Another benefit, I guess, it's because you have full transparency of the underlying asset. You can have more confidence that your investment is actually is actually a good one, and it's going to materialize into the returns you're expecting. So some of the drawbacks that I can see on this, though, is that it takes a lot of work up front to come up to do the homework and to do the due diligence. So, for example, we kind of looked at the overview of or high level picture of what the work would be for Berkshire, but you would also need to do it for every other company you're considering, and then compare them and do this. Do a lot of reading balance sheets and income statements to kind of figure out where the earnings or where the revenue is coming from. So that can take a lot of work up front, but I guess on the flip side, you can do once you set it, and you can forget about it and just revisit it once in a while to see if it's still worth.
Right.
So as far as the fundamental analysis goes, it makes a lot, because it seems to be the most rational choice to make when investing in the stock market. But in certain market conditions, lately, that we've been having, where the markets have been a little bit overpriced, or let's say you want to see a faster result in your investing or in your, then you may be wanting to consider alternative strategies that can give you faster results, or I guess also help you find better opportunities when the market is kind of overpriced. So what do you do then? In that case, the alternative is to look at what's called technical analysis. And technical analysis is actually like a big umbrella that where a lot of the other styles of trading derive from. But the one that I've been researching on is momentum analysis. Actually, or more to be more precise, is price momentum analysis. And the this strategy has been around for a while, but it has recently gained a lot of popularity, especially since it was kind of explained in behavioral economic terms back in 1913 by in a journal of finance, and we will provide a link to the paper in the notes of the video. But essentially, what authors found, is that using data from 1965 to 1989, a portfolio made up of stocks on the New York Stock Exchange that outperformed losing stocks over a period of 6 to 12 months continued to outperform losing stocks over the following 6 to 12 months by 1%. So, in other words, having price momentum strategy means instead of focusing on the intrinsic value of the particular security, you instead focus on the price movements of that security. So, if in the previous 3 to 6 months, the price has had a tendency to increase or exceed statistically derived in, then that means, or the theory of the concept states that you can expect that security, the price for that security to continue to increase in the next 3 to 6 months. Similarly, if it's increasing, right? So it sounds pretty straightforward, but there are multiple ways to actually apply this into practice. But one of the simplest ways I come up with to kind of explain it and explain it to our listeners today is by putting a simple moving average, right, or a combination of them. So, and one of the examples that I wanted to use today is, for example, Tesla, right? So, it's very volatile as a company. It kind of always since it started, but lately they've been having some major breakthroughs, and also they've, as all companies, public companies, they were also faced with the coronavirus pandemic effects, right? So this has presented this caused significant macro fluctuations in the price of the stock, and has presented a great opportunity to illustrate price momentum in action. So I wanted to share a little bit of what I mean, and I have a nice little picture that I want to show, that I put together, that I want to show and share. Go ahead and share my screen again. So this is the last year's worth of price data in Tesla, and what I did here is, aside from charting the candlestick patterns or the candlestick price data for Tesla from June 19 to yesterday, I also plotted the simple moving average for 20 days and simple moving average for 200 days. So you can see here that for looking at the 200 days gives us a kind of like a high level overview of the overall overarching tendency of the stock. So you can see here from June to about December of last year, it just generally had a tendency to decrease based on the 200-day moving average. However, if we look at also, if we combine this information with the simple moving average for 20 days, we can see that there was a crossover around the beginning of November, and it actually got confirmed. You can say that we had a confirmation around 5th of November 2019. So at this point, you can say this would have been a good point to enter our position, because you have a confirmation that the price has a tendency to continue increasing, and it is likely to continue in the next weeks or months. At the same time, as we all know, coronavirus kind of started to become a big issue around February and March, and we can see that very clearly here. Even though we had a tendency overall to increase, we started seeing a sharp decline in the price, but our simple moving average of 20 days didn't actually confirm this till March 13 of 2020. So, and I that's kind of like when the coronavirus news like became like a real threat, or more apparent threat to everyone, and that's when like we got confirmation. Like if we would have been at this point in time and seen this signal figure, and I would have been using momentum strategy, I would be using this as I need to exit my position and avoid potentially losing some of my returns. And we see again that even though towards end of March and beginning of April, the price rebounded, we actually didn't get a confirmation of that happening until April 16. So at that point, what this would have told us is this is a good time to start considering entering a position again in Tesla, because it is likely that price is increasing, and that's actually what we've been seeing for the past or so. So as far as price momentum, I don't really see that many drawbacks. The only one that I could come up with is that it requires a more active role on the from the side of the investor, because you need to kind of set your trigger signals or decide what your trigger signals are going to be, and make sure that you're monitoring them on a constant basis. Otherwise, you can be exposed to a greater risk than you actually want to be.
Right.
On the flip side, though, the benefits are very clear, right? So you can actually use fundamental analysis to kind of figure out what are some of the worthwhile companies to consider, and then combine that with momentum to see when it's a good time to actually enter or exit if you're looking for a more shorter term investment or position in this in your strategy. The other benefit, like we saw in Tesla, right, is like it started at some point in between March and April. It started rebounding, but if you would have just taken the price or seen that little piece of information and gone with that, you would have been exposed to a continuing tendency to continue declining until like later on April. So this is what's called a falling knife. So it helps you prevent those situations, right? So it helps you spot a falling knife and avoid it, catching a falling knife and avoid it. Right. And that's basically what I have. That's basically what I've been able to come up with for momentum investing, Jose. I'll turn it over to you for the rest of the.
That was great, Carlos.
Sure.
That was really good, Carlos. Thank you for explaining. So basically, what I got from your explanations is that fundamental analysis is actually grabbing the value of the company, and holding it over a long period of time. And momentum analysis is under the umbrella of technical analysis, where you're using tools and data to identify a position, right? And sort of an intermediate time frame. Is that correct?
Yeah, exactly. It's like I think momentum would be I mean can be used in very different or very varied a variety of different number of strategies. If you want, or if you are the type of investor that wants faster returns, maybe you can use it to kind of first spot companies or businesses that you think are worthy, and that are not going to like suddenly drop price and make you lose a lot of your money. But it can also help you to set some shorter term uh, strategies to make some early gains, cashing on those.
Right. That's a good deal. All right, Carlos. Well, thank you for summarizing those two different styles, and these two different styles were a little bit more long term. So what I want to talk about is the shorter term investing styles that you might see. So the first one that I want to cover is day trading. So day trading is the attempt to capture profit within one day trading or one trading day. So that means you have opportunities to trade a security within market open until market close. So you might hear of day trading all over online. There's all types of people just like flashing their Lambos and whatnot, right? But what I really want to talk about is what it is, how you can use it, and of course the benefits and drawbacks from it. So as I mentioned, day trading is capturing any profit within one day trading day. And it all revolves around the idea of identifying patterns and trends within a particular security. So the most preferred stocks to day trade or any kind of security is those that are volatile. So this might be for several reasons, such as like news headlines, earnings reports, any volume, anything like that can shake up the security that's day. So as Carlos had mentioned before, the underlying technique or the underlying analysis that day trading is using is technical analysis. And so technical analysis, as Carlos mentioned before, is sort of the statistical analysis of the historical prices for that particular security. And what you can do with it is you can build moving averages with these historical prices. You can look at the volume, the price movements. You can look at the RSIs. You can look at Fibonacci retracements. There's all sorts of different types of indicators that you can use when you are performing technical analysis. And the whole point of performing these technical analysis is to identify entry and exits. So while you're looking at these patterns and trends, you want to see, hey, where can I enter the position? Where do I exit? So day trading, of course, requires you to have a plan in mind. When are you going to enter? When are you going to exit? Where's your stop loss? What's your risk? And risk management is super crucial when you are day trading because, as I mentioned before, you are playing with really volatile securities. So you want to make sure that you have a solid trading plan installed so that you know when to call it quits or take your profits. So day trading, there's several different techniques or strategies that you can use while day trading. And I want to cover 4 of them, 4 really popular ones. The first one is scalping. So scalping is pretty much when a trader is taking multiple small trades on a single security that same day. So this kind of gives you the benefit of racking up really small profits throughout the whole entire day. So this is used when when you see a lot of small movements in a security, and you can take advantages of the valleys and peaks when you are scalping. Another strategy is event-based trading. So this is a strategy used when, as I mentioned, when there's like big headline news, such as like a company comes out with a new product, and there's a lot of hype built upon that. So day traders can take advantage of that kind of event. Or earnings reports came out, and the security there's all types of movement with that. So day traders can take advantage of that. Now, range trading is pretty much identifying the overbought and oversold points or areas in the security. And so that's pretty much identifying the support and resistance levels in that security. And this helps with identifying the entrance and exits of your positions. Now, there's also price action trading, which revolves around all the different indicators. So you can use like candlestick patterns. So, you have your morning stars, your shoulders, your head and shoulders, all types of patterns that people have identified before that you can signal when to enter or exit a trade, or identifying the trend of a particular security. So you could see that day trading really revolves around identifying these patterns and trends, and simply identifying where you can enter and exit. So this is sort of like in the idea of that history tends to repeat itself. So you want to capture those trends and benefit from those. So with that being said, I want to talk about some of the benefits and drawbacks with day trading. So there are several, right? So, but a benefit is if you are really good at it and you play your cards right, there's big profit to be made, right? And the good thing is you taking profit that same day. So you don't have to, wait months on end just to make, some profit. You take it with you. And since you're day trading, you take profits that same day, you can actually reinvest those profits that same day and go into your next position with it. And also, the benefit with day trading is that you avoid any type of overnight risk. That is any movements in the market that might happen at night while you're asleep. I mean, you're avoiding that, and so you can avoid substantial loss from that. So some of the drawbacks, of course, is it's really risky. I mean, you're dealing with really volatile securities and volatile positions. And so, yes, you can make a really substantial gain, but same with the loss. I mean, you can lose a really big chunk of your money if you don't know what you're doing. Another drawback is taxes. So since you're holding the security for less than a year, there are higher taxes that you have to pay. And so this will be considered as ordinary income tax, whether you gain or you lose. And a big one that I really want to emphasize is that day trading there is a really low success rate for day traders. Some say less than 10%, some say less than 1%. So you really have to know what you're doing in order to avoid this kind of risk, and to actually have a successful career with it. And even the most experienced day traders, I mean, they have their red days, so it's a really risky style to get into. So I talked about day trading. Now I want to talk about swing trading. Now, swing trading it falls under the same umbrella of technical analysis. The only difference between day trading and swing trading is swing trading, usually what you do is you hold that particular security for a few days to a few weeks, right? So it's still short term, but it's more intermediate. So as I said, swing trading revolves around around technical analysis. So swing traders like to use different indicators like the EMAs, all the moving averages, to identify any kinds of swings in the market. So the good thing about swing trading is that you're capturing the short-term gains at its maximum potential, because you are holding that security for a longer term than day trading. So fundamental analysis can be used and implemented while you're swing trading, since you're holding for a little bit longer, but it doesn't matter as much, because with day trading and swing trading, you aren't really interested in the future prospects of that particular company. All you're doing is looking at the price movements and price action. So, future prospects is not a concern. All you're concerned about is price action. So I want to talk about some of the benefits between day trading and swing trading. So some of the benefits is that you don't have to be with swing trading. It doesn't require as much activity and monitoring as day trading, right? So with day traders, usually, it takes a large amount of time, because you're constantly monitoring different charts and their movements and different positions that you might be holding. But with swing trading, you identify a position, you get into the position, and all it takes is some patience, right, for the play to initiate. And I want to show an example here. So I'm going to try to share my screen. Okay, so as I mentioned before, swing trading relies on technical indicators to help identify position. So right here, what we have is a classic example of a moving average crossover. And actually, Carlos covered this in his momentum section, where he was comparing or analyzing the Tesla stock. And what you see here is you see a moving average line of the 200, and you can see that the price in the charts are actually going below the 200 MA line, which indicates that the security is probably heading towards a downtrend. So swing traders might use multiple moving averages from different time periods. So for example, here we have a security that, and we have two moving average lines. So we have the 200 and we have the 500. And the way that you can utilize two moving averages is that if you take a look at this point right here, you could see that the short-term moving average is actually intersecting with the longer-term moving average. And anytime that the intersection happens, it indicates that there's some kind of trend change. So in this case, it's going down here. And if you're looking at this point right here, you can see that the short-term moving average is actually coming up above the long-term moving average. So that indicates that the security is trending upwards. We saw an example of how you can use the moving averages to identify position when you are swing trading. And so pretty much everything that you could do with day trading is what you do with swing trading, except swing trading is focused on more of a longer range of time. Some of the benefits with swing trading is there's less monitoring. You capture maximum short-term gains from the market swings, and you're focused on limited positions. All it takes is some patience and some time to cover those profits. And of course, the drawbacks are that you're holding overnight and over weekend. So you are exposed to any kinds of risks or market swings that might happen overnight while you're sleeping and you're still holding the position. So another one is, of course, the higher tax bracket. Since you are holding for less than a year, you are going to be taxed even more. And last but not least is, as I mentioned, it does require some patience and some time and discipline. So it really takes a really good trading plan to execute and do well in this trading style. So you have to know how to manage your risk. And a lot of people like to use risk ratios. As you can see, there's a lot of people that like to do like 1 to 3, where they'll be willing to risk $1 for every dollars that they can potentially make, or different ratios like that. So you don't want to risk something like a 1 to 1 where you're willing to risk $1 to make a $1, right? That doesn't make sense. So you really have to put a plan together and make sure that you execute and that you don't let emotions get in the way. Of course, emotion is a big part of managing and trading short-term gains or short-term securities. And that's because you need to know when to, take losses or when to take your profit. So emotion or risk management is another thing that you have to take into consideration. So that's it for day trading and swing trading. I wanted to kind of get your comments on what you think there, Carlos.
That's pretty cool. That's pretty a pretty nice explanation, Jose. Thank you. So my takeaway is that, well, there's a variety of different styles, right, for participating in the stock market. It sounds like, and I guess it mostly depends on how much time you want to allocate on being active on it, and also what's the level of risk you want to assume with your investments. Because there can be like, or you can say that there's the one extreme of having maybe using a lot of maybe taking a lot of upfront time to do your due diligence and homework for fundamental analysis, but you get the benefit of you just set it and forget it, and you have the peace of mind that you're actually making an investment decision that is low risk, and also get tax advantages because it's for a more longer term. It's usually for years. So that's one end of the spectrum. The other, and on the other side, you have day trading, right? Where you're a little bit more, not a little bit, like a lot, more involved in active on trading on a day-to-day basis. You assume a lot more risk, and also you pay a lot more taxes. Sounds like. Yep. So but at the same time, more risk comes with better reward. So if you do it right, if you do day trading right, you can make potentially some really nice profits. But I guess it's up to you. So that's my takeaways, Jose. What?
Perfect. I couldn't say it any better than you did. And it's all about just finding your style, what fits best for you. And of course, we just mentioned a few different styles. I mean, I'm sure there's a lot more out there, and feel free to just go ahead and explore your different options out there while you're investing. I do encourage you to explore but firstly, actually open up a paper trading account. That way you're not really risking any substantial losses with real hard-earned money, right? So open up a paper trading account, explore your different trading styles or different investing styles, and see what fits best for you. So I want to thank you, Carlos, for joining us in this video. And I want to mention our Deep Data Investing newsletter is out. So if you haven't signed up yet, all the links are down in the description below. So we'll have our website, we'll have all our social medias, and any notes that we might have, or like our books, links and stuff like that. So
I want to open up the discussion or the conversation with the audience. If you feel free to reach out to any of us on Twitter, we'll include our links on the notes, and just let us know. What's your strategy? Do you have any, or what do you thought about the content we shared? What was the thing that you found most useful, or did we miss anything? Let us know. We'd love to hear from you.
All right. Thank you, guys. You guys have a good one.